Hi, today we'll explore business analytics in the UK banking sector and how it helps the decision making, profitability, and operational efficiency. What is business analytics? Business analytics involves using data, statistics, and predictive models to extract insights and support strategy decision making in banking sector. It plays a critical role in optimizing profitability by identifying key financial drivers, managing risk through fraud detection and credit scoring, enhancing customer experience with personalized financial services, improving operational efficiency by streaming process and reducing cost. Now, about our data, we'll see that for this analysis, we have collected financial data from FAME covering 10 UK banks from 2014 to 2023. This database includes key financial variables such as turnover, net income, total assets, return on equity, return on total assets, and return on capital employed. In this presentation, we are going to cover so many points such as descriptive analysis, correlation analysis, scatter plots, regression analysis, and residual analysis. By end of this session, you will have a clear understanding of how business analytics can be leveraged to improve profitability, risk management, and overall competitiveness in the UK's banking sector. Bank needs. Now, see the rules in the business analytics. The first would be risk management and fraud detection. By analyzing transaction patterns, predictive
Now,
analysis
see the rules
can
in the
assess business analytics.
risk
The
and
first
detect
would be
fraud,
risk management
ensuring
and fraud
banks stay
detection. By analyzing
compliant.
and regulatory standards, customer relationship management analyzes help banks offer personalized services by predicting customer behavior and preference, improving customer satisfaction and retention. The third would be credit scoring and loan management. Machine learning models are used to evaluate creditworthiness, reduce default rates, and optimize the loan approval process. Operational efficiency and cost reduction. Banks can streamline operations and reduce cost using AI and automation technologies. Investment and portfolio management. Analytics supports better decision making by providing insights into market trends, asset performance, and risk diversification. Cybersecurity, real-time transaction monitoring, and advanced analytics help detect potential threats and reduce fraud. In the following section, we'll look at how business analytics specifically help in analyzing financial data to improve profitability. Now we'll have a look at descriptive analysis of the data. This provides a summary of key financial metrics for the banks in this. And the metrics we are going to see are mean, median, mode, and standard deviation. The first would be mean. The turnover is 14.064.83 million GBP, which represents the average revenue across all data points. The median in ROE is 66.85, meaning that 50% of the banks in the dataset have ROE value below this point and 50% are above. The mode will be the value is marked as NA, indicating there is no single most frequent value for this variable. Standard deviation for total assets is 639351.85, indicating a high variability in the asset value across the banks. This descriptive analysis provide a overall understanding of the certain tendency and the variability of the key financial metrics in the data. Next, we'll look into correlation matrix, which measure the relationship between different variables. There's different variables such as turnover and net income. There is a strong positive correlation indicating there is a strong positive correlation of 0.73, which is indicating that higher turnover generally results in higher net income. The second would be turnover and total assets. That also shows a very strong correlation, which is 0.93, that banks with larger assets tend to generate higher revenue. The third would be return on equity and net income. It shows a weak positive correlation, which is of 0.31, meaning that the while net income contributes to ROE, other factors like leverage and equity size also play significant role. Return on capital employed and return on equity is a strong positive correlation of 0.87, showing that firms with better capital efficiency and tend to have higher ROE. This correlation analysis help us understand the relationship between the variable and how to influence profitability. Now let's now let's visualize the relationship between these variables through scatter plots. So the first scatter plot would be turnover and net income. The scatter plot shows us an upward slope indicating positive trend where higher turnover leads to higher net income. However, variation may occur due to difference in cost structure and efficiency. The second would be return on total assets and total assets. In this correlation is a weak to moderate correlation. Larger banks do not always yield higher returns as increased assets can lead to diminishing return due to high operating cost. Now, third will be return on equity and net income. The return on equity and net income scatter plot also shows a moderate positive correlation, but ROE is influenced by other factors beyond just net income, so it shows a moderate and positive correlation between it. The last would be return on capital employed and return on equity. This is a strong positive correlation which you can see and visible supporting the idea that efficient use of capital leads to higher return on equity. These scatter plots provide visual evidence of relationship and trends between key financial variables. Now let's move to the multiple regression analysis. This analysis examines the factor influencing profitability, especially return on equity using various financial variables. In this, the R squared value of 0.704 means 70.4% of the variance in ROE is explained by the independent variable. This indicates a strong model fit. Now we'll see about the coefficients which are turnover, which is a positive coefficient of 0.000502 with a p-value of 3.29 e-05, suggests that higher turnover leads to higher ROE. Total assets, which is a negative coefficient of minus 1.17 e-05 with a p-value of 0.000176, indicates that larger banks tend to have lower ROE. The third would be return on capital employed. A strong positive coefficient of 0.789 with a p-value of 3.75 e-05 shows that efficient capital utilization and significantly linked to higher ROE. Net income and return total assets. These have higher p-values indicating they are not statistically significant in predicting ROE in this model. This regression analysis confirms the importance of turnover and capital efficiency in driving profitability. Finally, let's take a look at the residual, and residual represents the difference between the observed values and predicted values in this. The standard error for the 6.577 data, that is some variability in the data that is not fully explained by the model. This presence of insignificant variables like net income and return on total assets implies that removing them from the model could improve accuracy. These residual plots confirm that the model can be improved by focusing on more significant predators such as turnover and capital efficiency. There are five residual plots which are created, which is return on capital employed, turnover, net income, total assets, and return on total assets. Now let's summarize this presentation. To summarize this presentation, business analytics is vital for improving decision making and optimizing profitability in banking sector. The regression analysis shows that turnover and capital efficiency are more significant drivers of ROE. Banks should focus on increasing turnover and improving capital efficiency while carefully managing total assets and enhance profitability. The analysis also highlights areas of improvement in predictive modeling by removing insignificant variables. By leveraging business analytics, banks can not only improve profitability but also strengthen their competitiveness in a rapidly evolving industry. Thank you. These are the references.